Kantrowitz, I'll start with you because your note, it makes me chuckle. You say crowding is at an extreme, but stay growthy. Why?
Yeah. Well, we have a backdrop now where you have more crowding than ever by some measures. Looking at just how crowded, how many institutional owners do own stocks relative to average stocks, and it's even higher today than 2000. The question, though, and we'll say stake fee is really about fundamentals, the reason that these are crowded. And the question is, did something change today? Something going to change that is going to change the story about why investors like these stocks? And really, valuation has been, the single biggest issue for most of these names. Yet we continue to see them outperform because the fundamental story is still intact.
And what is that fundamental story, real quick?
It's from a macro perspective. It's a continued backdrop, very low interest rates staying low a long time. It's a lack of stocks everywhere. The reality is in the S&P 500, there are only 50, 60 names that have actually grown their revenue anywhere near those stocks that you just mentioned. And so it's not going to change. Investors aren't going to change.
Michael Santoli, let me turn to you then. So I think essentially what Kantrowitz is saying is that you have super low interest rates. We've seen even after the big Fed move last week, that's still the case. People want growth because they're not confident of where else they might get it. But is that piece of it starting to change? When you see the better manufacturing surveys, hear about the industry's hiring?
It's starting to change, Kelly, in the sense that the only game in town may no longer be those long-term secular growth stories that have these durable cash flows, which have been revalued much higher, given the fact that, we have corporate bond yields at 2% and an easy Fed. It's actually broadened out quite a bit in the last several weeks. If you look at things like industrial and transport stocks, if you look at consumer discretionary outside of Amazon compared to more defensive things like consumer staples, those things have been trending in a positive direction, just not as dramatically. They're just not capable of piling on the amount of market cap that the huge growth stocks are. And also, let's face it, they don't captivate this sort of public, the excitement that you have around a handful of names that really drove them to extremes. The setup that you had for this segment, presuming everyone already figures all these stocks are up every day.
Right.
That's exactly why they're not up every day like today.
So what happens now? Because it's one thing when you say, hey, Virgin Galactic was up, and then it's a tiny name in the grand scheme of things. But when Tesla, Mike Santoli, is like the eighth biggest stock in the world at this point, what happens if that one reverses and gives up the majority of its gains?
Well, we're seeing a small experiment in that right now. It's off the highs. The rest of the market, in fact, if anything, the weakness today, this reversal that you've seen to the downside in some of the momentum stocks, it's incredibly localized at the moment. It's Apple, it's Tesla, it's Zoom. It's the stocks that everybody was complaining about. They were up every day going into today, and we have an overall market that's actually up. So you do have a little bit of a safety net underneath it. It can't last forever. That choreography, of course, might fail at some point where you have this sort of rotation and this rebalancing in other areas of the market. But I do think the fact that Apple can be down as much as it is and how much market cap it has and the rest of the market more or less absorbs it, at least for now, it's okay, even if stuff is so overbought on the tech side that even much more of a give back. A normal pullback is about 7% in the NASDAQ 100 right now. Extremely normal, like we've had multiple times in the past few months.